Dividend investors, bonjour, Mike here. Today we are covering 4 undervalued stocks on the US market. So last week we covered the Canadian ones. This week we're getting the same formula where I talk about the business model, what I like about the stock, the dividend triangle analysis, the PE ratio trend, and the dividend discount model. Today you're going to find that quite interesting because the last 2 are technology stocks, and obviously the dividend discount model doesn't work that well, but still we are able to prove that there are some great values here. My name is Mike and I'm the founder of Dividend Stocks Rock. I help investors invest with more conviction so they can enjoy their retirement. And one thing that is great about a boost of confidence is definitely buying a stock where you have that feeling it's a bit undervalued. Not super easy to do because there's always uncertainties, but today I'm going to show you 4 companies that could be quite interesting to look into, do a deep dive. Obviously, today is just about talking about them a little bit. Put them on your list, but please do your due diligence before you press on that buy button. So let's get started with the first one, who's a small cap in the construction world. So Apogee. Apogee is mostly making architectural, yeah, very difficult word to say for a French guy, framing and glasses. So what they do is that they are offering framing and glasses for large buildings, for commercial buildings, institutional ones, and also high-end multi-residential family properties. So they're all in the big construction work. Obviously, it has slowed down a little bit. We expect it's not going to be a good year in 23, possibly in 24 as well. And this is why it's interesting to get into this kind of company in this kind of situation. Now let's move on to the dividend triangle. As you can see, it has, the business has been hurt during the COVID, so revenue and earnings decline. What I kind of like though is, especially for a small cap, that company that's not even having a market capitalization of $1 billion, it pays a dividend yield of like 2.4, 2.5%. And yet they were able to increase their dividend payment during the crisis. So while they were not sure if they would get more contracts, how it's going to look like going forward, chain supply disruption, delays in the construction contracts, all of this never affected their dividend growth policy. So this is why this one is on my list. As you can see, the stock price has been pretty much stable for the past 5 years. So it's not going to be like, oh my God, I need to buy this supercharged stock. But maybe for the future, that could be quite interesting to look into this one. In terms of the PE ratio over the past 5 years, as you can see, there's like a crazy fluctuation over there. Obviously, they lost money because they were not able to do a lot of money. They were not able to do a lot of contract during the COVID. So this is why you have like some kind of like crazy multiples. But what is important here is to see that before the COVID, the stock was trading between 10 to 15 times the earnings, and now it's down below 10, which makes it even more interesting. And now I'm thinking, you know what? Small cap during a period where we fear of a recession, the stock price doesn't move that much, but the dividend keeps on growing. There's definitely something brewing here, and that could be what I qualify a high risk, high reward company. Apogee also grows by acquisition, so that could be interesting to see if they are able to keep up with their game during the tough times, buy some competitors and just grow because others are struggling and they have a sound balance sheet with not too much debt. Finally, if you look at the dividend discount model, and we have discussed that in the previous video, and if you're wondering about my favorite Canadian undervalued stocks, just click on the link below in the link description. But the problem with the dividend discount model is that it's going to give you a value solely based on the future dividend. So it does not discount anything about growth, anything about the acquisition. So the stock price gain doesn't exist in this world. It's only the dividend payment. So anything that pays a yield below 4%, it's very difficult to see a value using the dividend discount model. So the stock right now is trading at 40 bucks. The intrinsic value right now is at like $27, $28. We're very far behind. As you can see, if you just move the discount rate from 10 to 9, you get almost a good valuation. But the problem with that is I'm not willing to get a small discount rate of 9% if the company is a small cap that could go like belly up in a cyclical market. So I need to have like a higher discount rate just to show the risk of that investment. So long story short, there's a lot of potential. The narrative is there. The PE ratio is really low. But if you're just a focused dividend investor, it's not probably going to be a good pick for you. However, I have one that could be quite interesting, and that's Bank OZK. So Bank OZK, about 4 billion in market cap, so we cannot talk about a huge bank. It's a regional bank, mostly in southern states such as Texas and Florida. They have the same CEO for ages, which is kind of cool because it brings some stability here. It pays a yield above 4%, so that could be interesting. And we all know what's going on with banks in the US. There's like almost like a simile bank run for all those regional banks. The problem is, as interest rate rose too fast, the bond value in their portfolio started to drop like a rock. At first, they never disclosed that they were losing money on paper because it's on paper, and we're talking about treasury bonds. So all regional banks were just like, dude, there's no problem here because we're going to wait until maturity, and when the maturity comes, well, the government's going to pay us back. So it's all safe, it's all good. So we can avoid to mark the value to market, and instead just say, well, we bought it $100, it's going to be worth $100, and we're all clear. Problems happens when some people need their money and they were drawing from their savings account, and now they do not have enough capitalization and they need to sell those bonds at obviously a loss. So here's the big fear around all those regional banks. As you can see, those that has run into a lot of problems are down 50, 75 or like 95% because they're going bankrupt. As for Bank OZK, the stock price is dropping. It opens an opportunity here, but the stock is still not too bad. The bank is still doing well, and we're going to look at that in the dividend triangle. So interestingly enough, as you can see, there's a smooth line at the bottom. So those are the dividend increases. Like every quarter, the bank is increasing its dividend by 1 penny. So that is a very strong dividend grower. What I like is while other regional banks are crying for help and they're just like, save me, please. So it is a very good sign of management being confident and the bank having a very robust balance sheet and also keeping their deposit at bay. So that's not really a problem. You can see revenue is going up. That's natural. As interest rate rises, net income will rise as well. But they do have something very special. Instead of just having those banking, savings and loans activities, OZK also runs a RESG group, so real estate specialty group that focuses on certain properties and parking lots and all the things that like most of the bank don't wants to finance, and they do that mostly in New York City and in Miami. So the market is growing there. There's a high demand, and obviously we're talking about like high ticker price volume. I have to put a word of warning here though. While OZK has been thriving mostly due to this RESG group, well, as you can see, it brings a lot of volatility in the stock price. Back in 2018, they had like one client that went default. They had to write off a debt, and that crushed the stock on the same day. So you have to be careful with that type of stocks. You have to know where you're getting into. But at the same time, what I see from there is a relatively solid dividend triangle, and the fact that this bank is not crying for help right now is probably a great opportunity, and the price is likely going to bounce back if everything goes smoothly and they do not come with a surprise. In terms of PE ratio, what do you see here? I mean, it's pretty much valued like under a Canadian bank, like 7 times the earnings, definitely below the 5 years average. Even if you like forget about like this craziness between 2020 and 2021, but besides that, we're more looking at a bank trading around at 10 times the earning. Right now we're at 7 times, so there's definitely an opportunity in terms of value here. Moving on to the dividend discount model, at this time we're pretty much on target. So the stock price is around $32, $33. The discount rate model shows an intrinsic value of 34, so not a huge deal, but at the same time, we use a discount rate of 10% to reflect that it's a regional bank, a small one. And the investment thesis is really about OZK continuing to finance those RESG group and not having to write off any debt. So this one is to be followed quarterly just to make sure that everything keeps running smoothly. Before we go to the fourth one, so the last two tech stocks, I want to invite you to a webinar that is happening today. So on May 18th at 1 p.m. Eastern time. And if you're watching this video late in the afternoon or another day, don't worry, there's a replay as well. So the both links are right there. So dividendstocksrock.com/YouTube-webinar for the live event that will happen today, May 18th on 1 p.m. Eastern time. And if not, you go to the second link, which is dividendstocksrock.com/replay. So the webinar is about how to handle volatility in your 40s and also in your 60s. So the point here is when you're in the accumulation phase, there are a lot of challenges that you're gonna face as an investor while the market goes crazy, pretty much like we have in 2023. So you need to have a solid strategy. There are like ways that you can seize opportunities, but you mostly like of conviction. You look at the market and you're just like, yeah, I have money on the side, but I'm not too sure how to invest, and I'm not too sure if the market is not going to crash next week. So you're sitting on the bench, you're watching the game being played, and you're not scoring any goals. So this webinar will help you to know yourself a little bit better, have a strong strategy, and having that conviction to seize those opportunities. However, if you're in the withdrawal phase, the decumulation phase, you're retired, you live off your portfolio's income, well, the timing of withdrawal when the market goes sideways is crucial, right? Because if the market keeps going down and you're withdrawing on top of that, it has a tremendous bad impact on your retirement plan. So you get scared, you're not too sure how to invest. You try to focus on income, but then those income stocks, sometimes they cut their dividend. So you're even in a worse place. So this webinar is for you, where the second part of the webinar will all about protecting your portfolio, making sure that you are more diversified, and also having a strategy to avoid panicking when the market goes down and still be able to withdraw the money according to your retirement plan. So again, you can register in the link below, dividendstocksrock/YouTube-webinar, or for the free replay, dividendstocksrock.com/replay. I'll have newsletters for you about payout ratios. I have stock lists for you to help you out seize the opportunities. You have like a bunch of freebies. It's a rendezvous. Now back to the third undervalued stock in the US, and this one is all about communication. So a tech stock that is mostly driven by royalties and mostly driven by the smartphone companies. Have you guessed it what it is? Yes, it is Qualcomm. So Qualcomm is behind the 3G, 4G, and 5G technology. So to help devices to communicate across the wireless network, they create those chips, and what they do is they get a license back, they get a royalty back, and this is how they have built their model. So they're mostly in smartphones, so their biggest clients are obviously Apple and Samsung, but they're well aware that they're quite dependent on them. So over the past few years, they tried to diversify throughout automotive and also industrial clients, just to make sure that Apple doesn't come one day and say, you know what, we're not going to pay you your royalties anymore, and we're going to develop our own technology, and thank you, goodbye. So as you can see in the dividend triangle, it was a nice ride, but now we're starting to see since 2022 that there's some kind of like a slowdown happening, both for revenue and earnings, telling you there is a slowdown also for smartphones. I'm not telling you any like weird news here, you already know about that, but this is also explains why the stock went from like $180 to all the way down to $106. There's a big slowdown there, but on the other side, the company shows a lot of strength and a lot of confidence in its business model by continuously increasing its dividend, actually even being more generous over the past 3 years than they were before, which is also a pretty good sign. Moving on to the P ratio, as you can see for Qualcomm, I mean, it's just downhill all the time. So definitely the market is telling you, yeah, this company's getting mature. They're going to get a lot of headwinds. Probably that the sales of smartphones are going to affect the sales of their own products. So if everything slows down, they're going to follow. We're probably going into a recession as well. So all of those uncertainties pushes the stock price lower and also the PE ratio lower. But at 10 times the earnings for a company that has still a great market, a great place in this with their innovations and their products, I'm pretty sure that they can turn around and they will be part of the next wave of new iPhones or other smartphones by like Google or Samsung. Finally, this one, I found it quite interesting when you look at the dividend discount model, because by just changing the discount rate from 10 to 9, you get the intrinsic value at 104. This is one of the reasons why I'm not a super fan of any kind of valuation methodology. I'm gonna look at the PE ratio trends, I'm gonna look at the yield trend as well, a little bit on the dividend discount model, but I'm not going to spend like 5 hours trying to calculate what is the intrinsic value of the stock, because you know what? Here you have like the perfect example. If I just tweak the numbers a little bit, I go from overvalued to fairly valued by just one single number. So imagine that I can play around with my calculator and get a whole different story about the same stock just because I came up with different assumptions. So always keep that in mind when you do valuation and you think that a stock is undervalued. It's only based on your assumptions, and assumptions are based on guesses, and your guesses are just as good as mine and are just as good as your neighbors. So always take valuation with a grain of salt. The point here is always to look at strong companies with a solid dividend triangle and a robust business model. This will lead you to being a better investor. This will help you to build a stronger portfolio. And if you want more information about how you can do that, regardless if you are in the accumulation phase or the retirement phase, sign up to the webinar right there, Dividend Stocks Rock /YouTube-webinar or Dividend Stocks Rock /replay for the free replay. No registration required for the replay. You just click on it and then boom, the video starts. So now let's end this video on my favorite technology stock that is not in my portfolio yet. Well, the problem is I already have a great exposure to the technology stock, and at one point you have to restrain yourself, right? Like too many is like not enough. So I decided to skip on Broadcom AVGO, but this is like a bell of growth. This company grows by acquisition all the time, has become a major player in the semiconductor business, but also offers infrastructure software. So as you can see, they are buying other competitors, they're building that together, and then they are offering cross-selling products, which grows very well. That works very well for Broadcom over the years. They have built a great expertise in acquiring and integrating those businesses in their business model. And one thing that is important to mention is one of their largest, most important growth vector is RF filters. Like this is included in your smartphones. So obviously one of those bigger, their bigger clients are Apple and Samsung, similar to Qualcomm. But on the opposite side, they are a lot more diversified than just having like this huge play on smartphones. They also offer a lot of other products to a lot of other industries. Moving on to the dividend triangle, as you can see, that is just always going up for revenue, almost the same thing for earnings, and then boom, you have the same thing for the dividend growth. Actually, it's kind of crazy, but they increase their dividend so fast that they show 32% annualized growth rate over the past 5 years. Obviously, you cannot expect this company to continue at this rate, but just to show you that there is a great combination here of a company offering a yield over 3% and on top of that, offering you some solid growth. The stock price has been like pretty much hovering for like not any profit since 2022, which is pretty good actually considering the technology like drop that we had in 22. So one of those resistant company was Broadcom, and this shows how resistant this business can be. Even when the sector is going down, they still remain in very good shape. Looking at the P/E ratio, you can see it goes all over the place, but now it has pretty much stabilized around 20 times the earnings. You're gonna tell me it's not a super deal, but in the tech world, for a company that is growing double digit, I would argue that paying only 20 times the earnings is a pretty good deal. If you look at how Apple is trading or how Microsoft is trading, I think that Broadcom is offering some kind of like a very interesting play here in terms of valuation, especially if you consider the sector it's in. You have companies trading at way higher multiple, and this is also one thing that is important to look at, not just the number, but compare it to the rest of the industry. So sometimes, like when you think about technology stocks, they will trade at a very high P/E ratio, so 20 is not that high for that sector, obviously. Finally here, similar to what happened with Qualcomm, you have to play with the numbers if you want to find a good valuation using the dividend discount model. As you can see, I've used a dividend growth rate of 7 and 5%, which is pretty low compared to what Broadcom has offered us over the past 5 years. On the other side, it's pretty much like dreaming, thinking that this such high growth is going to happen again. So you have to be careful and create that balance in your mind when you play around with those valuation models. Not just be too positive, too conservative, trying to find like the answer here, but it's more like a mix of many metrics that will lead you to buy a stock instead of just focusing on one model only. So, all right, investors, I hope that you have enjoyed this video. Let me know in the comment which stocks you think is undervalued on the US market, and hopefully we're going to see you at the webinar. And until the next video, don't forget to stay invested.